Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about a fairly polarizing topic, understanding option Greeks. And I say polarizing because some of you really love math and geeking out and talking about option Greeks. And some of you really do not like the Greeks at all because you find them confusing, they're scary, they're actually quite difficult to calculate. And there are so many of them that it becomes a little overwhelming. So today what I want to do is I want to take a bit of a deep dive into option Greeks and hopefully provide it to you in a way that's understandable. But before I do, I just want to say that despite the fact that option Greeks are extremely important to understand, you don't actually have to do any of the math yourself anymore because platforms like OptionsPlay were designed from the ground up to calculate these things already for you. I will show you how the tools that we've built will allow you to implement what we're going to teach you here today without having to do any of the math yourself. Okay, so that's really the goal here, is to help educate, make sure you understand. And then what I'll do is I'll do a lot of examples to show you why it's important to know or understand the Greeks and really what you get out of understanding the Greeks. So those are the things I want to cover here today. Now, before I get started, how many of you are familiar with the option Greeks? Please type yes if you are, or no into the chat window if you are not familiar with the option Greeks. You can bring up the chat window at the bottom of your screen. Okay, I see a lot of yeses actually, which is great, but I do see a fair number of no's. So again, for those of you that have responded yes, many of you have told me that you love the Greeks, and many of you have told me that that it scares the crap out of you because you don't really understand it. So let's dive into that. So before I do, just a quick reminder for those of you that are first-time users of OptionsPlay, welcome. You can sign up for a free 30-day trial to the tools I'll show you here today. Once you pass that 30-day trial, membership is just $75 a month or $500 a year. And for you to sign up for that free 30-day trial, just click on the link that I sent you in the chat window. This will give you a free 12-step options trading course to help you jumpstart your options trading and daily trade ideas that we send out so that you can follow along our ideas and see how we trade in the markets. So with that, let's go ahead and get started. I'm going to cover a lot of things here today. Hopefully I have enough time, but these are really important things that I want users to understand. Especially if you're going to be trading options, these are concepts that you absolutely need to understand. So we're going to start off by talking about what are the option Greeks basics. We're going to talk a little bit about what you get out of learning how to understand option Greeks. Then we'll dive into 4 of the most important options Greeks, which are delta, theta, gamma, and vega. And right off the bat, this is usually where we throw most people off, right? Because you're saying, what the hell is delta, theta, gamma, and vega? And they're in terms that are not in English, it's in Greek, right? So this is really where a lot of people get a little freaked out. But we're gonna focus our attention mostly on delta and theta because those are really the 2 that have the largest impact to our trading. But we will cover gamma and vega because they are important to understand, okay? Then once we dive into the option Greeks, what I'll do is I'll actually bring up OptionsPlay and show you some examples as to how we calculate these for you so that you don't have to do the calculations yourself. And once we understand that, what we're going to do is we're going to look into a few things. I want to break down volatility a bit for you guys because I get a lot of questions about volatility and a lot of you use volatility in your trading. So I just want to point out a few things that you should know about trading volatility or understanding about volatility. Then we'll also do the same thing about time decay. And the reason that I want to bring up time decay is because it's really one of the most important aspects to trading options. And by understanding time decay, it'll really help you understand where you should choose your optimal expiration dates and strike prices. And so once we understand time decay, we can have a much better understanding as to why, when I teach you, when you're going long, you should use certain options, and when you're shorting, you should use other options. Once you understand time decay, visually, it'll make a lot more sense. And then lastly, what I'll do is I'll go through I want to go through one case study to show you kind of if you trade in the money, out of the money, at the money options, what is the actual difference? Because a lot of times I get questions around which option should I trade. So I think a case study will help illustrate which one you might want to utilize for your portfolio. So let's start by talking about understanding the Greeks and why do we study option Greeks? So first and foremost, the reason that we study the Greeks is because there are a lot of things that influence the price of an option. So whether you're buying an option and you want that option to go higher, or if you're selling an option and you want that option to go lower, there are various factors that affect that option's price. So studying the Greeks help us understand what are those factors so that we can understand what we can expect to happen in the future. So first and foremost, we study it because we're trading these things and we want to know what affects that price of an option. The same way that if you trade a stock, what affects the price of a stock? Future growth, earnings expectations. There's lots of things that affect the price of a stock, right? You study those things before you trade a stock. That's why it's important to study these things before you trade an option. Second reason is because they're very useful in helping us select various expiration dates and strike prices. So in my opinion, whenever you're trying to trade a strategy, first thing you have to do is pick an expiration date and a strike price. How do you go about doing that? Option Greeks give us some pointers as to where we want to look and where we should start. And whenever we talk about strategies and any of my webinars, whether you've watched them for cover calls, whether you're trading simple calls or puts, or if you're trading very complex credit, debit, maybe even straddles, strangles, butterflies, condors, it mostly evolves around delta, which is a really important Greek to understand because delta helps us pick the right expiration dates and strike prices. And lastly, the reason that we study the Greeks is because we want to know what the potential P&L or the profit and losses for our positions. So these are the reasons that we want to study the Greeks when we're trading options. So I'm going to start off by talking about the most important one, which is price or delta. Delta gives us an understanding of the impact that a directional move of a stock has on our options position. So every single option will have a delta. And what delta tells us is the change in the option price with respect to the change in the underlying stock price. Because every single option that we trade has an underlying stock, what we want to know is how much our option is going to move with respect to a certain move of the underlying stock. So if you have a call option or a put option or any option that has a delta, the delta will tell you how much the option will change with respect to the stock. So if you see a call option with a delta of 0.5, what that's telling you is that for every dollar that the stock moves up or down by, the option will move by half as much, 0.5 as much. So for example, if the stock moves up by $1, you should expect your call option to move up by $1. If the stock, by 50 cents. If the stock moves down by $1, you should expect your option to lose 50 cents. That's what delta tells us. So in an example, let's say you buy a 2-month call option on Apple. You buy a $300 call option and you pay $15 for that call option. And during this time, when you own this call option, the stock moves from 300 to 303. So it moves $3 higher or 1% higher. So the question is, how much money should you make from your option? And that's what delta helps us understand. So this $3 move, because we know that delta of the option is 0.5, and for every $1, the option will gain 50 cents. So if the stock moves $3, the option will gain $1.50. So what that means is that our option price will move from $15 to $16.50. It increases by $1.50 because the stock moved up by $3. So this is how we can utilize Greeks to help us calculate what is the potential outcome of our option strategy when we expect the stock to move in a specific direction or a specific magnitude. Okay, so fairly simple and I think straightforward. So before I move on, I just want to make sure everyone understands the concept of delta. Delta helps us understand how much the option will move with respect to the stock, a move of the underlying stock. If that makes sense to you, please type 1 into the chat window at the bottom of your screen. Okay, perfect. So delta, I think, is pretty straightforward. Now, the reason I say this is the most important Greek to understand, it's actually because delta is actually the Greek that has the largest impact on your underlying of your underlying option price, right? So when you buy an option that costs $15, the thing that's going to move this option price higher or lower by the largest factor is going to be delta. Because as you can see, delta here has a factor of 0.5, which is actually fairly large. When we go through the other Greeks, you're going to see that they're relatively small. There may be 0.1, 0.07, 0.02. You're going to find that delta really is the one that has the largest impact of your stock price, of your option price, which is why it's really the first and foremost thing that you need to pay attention to, which is why when you're trading options, the directional view that you have on the underlying stock is the most important thing to look at. Okay, so I just want to make sure everyone understands this. That's why we covered delta first, because delta has the largest impact on your option price throughout the life cycle of your trade. Now, the second most important one is time. Because options expire, and there's a time limit as to how long you have to exercise your option, what happens is actually, and I'll come back to this in a little bit, but the value of your option will actually decrease as it approaches expiration. So what happens is time has an impact on the value of your option. So that's expressed by the Greek theta. Theta tells us the change in the option price with respect to the change in time. So if you see an option that has a theta of 0.05, what that's telling you is that this option will lose 5 cents per day that marches on. And obviously we can't control time. Time will march on. So theta just gives us an understanding as to how fast the option will actually decay, or what we call time decay. And if you've ever heard of the term time decay, please type yes into the chat window. So in the example before, I bought a 2-month call option, a $300 call option on Apple, which is currently trading at $300, and I pay $15 for that option. And we talked about in the previous slide that if Apple goes from 300 to 303, what delta tells us is that my option will increase from $15 to $16.50, which is a 10% gain in my underlying underlying option position for a 1% gain in the underlying stock position. However, if let's say the move from 300 to 303 didn't happen instantaneously, it took a week for that to happen. Now we can utilize theta to give us an understanding as to, well, how much money did we lose to time decay? So we said that theta here is 0.05, which means that we lose 5 cents per day. So in a single week, we know that there are 7 days. So if we multiply 0.05 by 7, what we get is 0.35. So what that means is that we've gained $1.50 because of delta, because the stock moved up $3, we gained $1.50. But because it took a week to happen, we lost 35 cents. So that's how we know the ending value of our option goes from $15 to $16.50, and then from $16.50 down to $16.15, which is a 35-cent loss from the $16.50, which means our total gain at the end of this 1 week is about 7.6%. So that's how we can utilize Greeks to give us an understanding. Well, if the stock moves up 1% in a week, how much money do we actually make from our trade? And you can do this for any type of scenario, whether you think it's going to move up $10 the next day or $15 over 3 months, whatever time span you have, you can utilize delta and theta to give you a sense for what your value, what the value of your option will be at some point in the future. Okay, so that's the reason that we want to leverage delta and theta. So if that makes sense to you, please type 2 into the chat window. Perfect. I see a lot of 2s. Okay. Now let's take a look. Okay, so delta and theta, again, are the 2 most important Greeks, because these are the 2 that have, in my opinion, the largest impact on your actual value, right? So when you're trading an option, you want a directional move of the stock to move in your favor, which is delta. And if you're buying an option, theta is working against you. If you're selling an option, theta is working in your favor. So that's one of the things that we're going to cover in the next few slides, is to really understand how you can utilize these to your advantage. Now, this is where we start getting into some of the territory that people start to get a little confused. And don't worry, because I will show you how we actually do the work for you, right? So before, we talked about delta, right? We talked about if the stock went up $3, we can use delta to calculate how much money we can make and how much money we would lose. But guess what? Delta is not a constant. Delta actually changes. And there is a Greek called gamma, and gamma tells us how much delta changes by. Now, this is where I tend to lose a lot of people, and people tend to be scared off saying, what does that mean that delta changes? And the only thing the only thing I think you need to know from this is that delta, the changes in delta really work in your favor, okay? So gamma tells us how much delta changes when the stock price changes. So if you see a gamma of 0.02, what that means is that delta will increase or decrease by 0.02 for every $1 change in the stock price. So what that means is that in the same example, we buy a 2-month $300 call option. And let's say that option starts off with a delta of 0.5. Now, when the stock moves up $3 in the previous example, we talked about that, we take 0.05, multiply it by $3, and that means that the stock will roughly, the option will roughly move up by $1.50. That's actually not 100% true, because by the time the stock moves up $3, the delta actually increases. So, which actually works in your favor, which means that instead of actually making $1.50, you're actually making closer to maybe $1.70, because delta increases as the trade goes in your favor. And the best part of all is the fact that if the trade goes against you, meaning if the stock, instead of going from 300 instead of going up and goes down, let's say it goes down to 297, instead of losing $1.50, you actually only lose maybe about $1.35, $1.30 or so, because delta actually starts to decrease, okay? And that's actually how an option gets its hockey stick shape. So a lot of you wonder, well, how does a call option have this shape, right? Because how many recognize this shape that I have here on this screen, where a call option, you get increasing leverage, or if you get if you call the directional move of a trade correct, you get unlimited gains to the upside. But as the trade goes against you, you have limited losses. You can't lose more than what you've paid for, right? That's actually how you get that, because delta is not a constant. It changes. If delta was a constant, then what you would have is a line that just looks like this. But instead, you have a curved line, and it's because delta will decrease as you get more and more wrong on your trade, and increase as you get more and more right. And delta will go all the way up to 1. If the stock goes up by 100%, your delta will go from 0.5 to basically 0.99. And if the stock goes down to 0, delta will go from 0.5 to basically 0. So that's how you get this asymmetrical risk that we talk about when we're trading options, is really gamma. Now, again, you don't have to remember how to calculate this stuff, because we do it for you, but it's so important to understand how we get this asymmetrical risk, and it all comes down to gamma. Okay, so gamma changes delta as it goes in your favor. It increases delta as it goes in your favor, so you make more and more for every dollar that the stock goes higher. And for every dollar the stock goes lower, you actually lose less and less for every dollar it goes down. Okay, so that's what gamma means. Okay, so please type 3 into the chat window if that makes sense for you. And if it doesn't make sense, it's okay. Not everyone understands it on the first try, but I'm hoping to try to break this down in a way that's easier to understand. And lastly, change in volatility. Vega. Some of you that have ever traded implied volatility, or heard of implied volatility, or even heard of the concept of buying, options when vol is low, or selling options when vol is high, you think about those in volatility terms. So Vega is what tells us the change in volatility. So Vega tells us the change in the option price for the change in implied volatility. So when you hear about people saying that they sell options when vol is expensive, they buy options when vol is cheap, what they're really doing is they're either going long or short Vega. So Vega of 0.1 tells me that the option price will increase or decrease by 10 cents for every 1% change in implied volatility. Now, I know this is a mouthful, But let's say that call option that we bought on Apple, the 2-month $300 call option that we paid $15 for, let's say at that time, Apple was trading at a 20% implied vol, right? So again, some of you may have heard of, vol is cheap, vol is expensive. So if 20% vol on Apple is really cheap and you think it's going to move higher, then if vol moves from 20 to 21%, what that means is that your option price will increase from $15 to $15.10. Or if volatility decreases by 1%, your option will be worth $15 down to $14.90. The one thing I will point out here is notice how small the impact of volatility to the option price a change in volatility has. Even if volatility increases by 50%, from 20% to 30%, which is a massive move in volatility, what you're looking at is the option goes from $15 to $16 or $15 to $14 if you get if volatility gets cut in half, which again is a massive, massive move. So the one thing I want to point out is that volatility, while important, actually has a fairly small impact on the actual value of your option. So keep that in mind the next time you're trading options, is that I unfortunately see a lot of people use volatility as their sole decision as to which strategy they want to use, right? So many of you may even do this today, where you say volatility is high, so I'm going to sell credit spreads, or volatility is low, so I'm going to buy debit spreads. But just remember, volatility actually has a fairly small impact on your option pricing. It has an impact, no doubt about that, but the impact is usually not nearly as large as the delta. And the delta between a debit and a credit spread is very, very different. So make sure that you look at delta first before you look at volatility, for those of you that use these Greeks for your trading. And I just want to put a little note here on volatility, is that implied volatility, which is the measure of a stock's expected future volatility based on the current options price, volatility is something that I think many times is misunderstood. Meaning, again, this is for example a chart of the S&P 500 implied volatility. As you can see, there's a bit of an equilibrium level, probably somewhere around here or so. And we call volatility mean reverting because the idea is that when volatility is high, you usually get a check back. And this is what vol traders typically refer to as selling vol when it's high, buying vol when it's low, because they basically expect that volatility is going to revert back to the mean, right? And you can see, generally speaking, it does do that, right? So when it gets too far away from this red line, it tends to check back, right? But keep in mind here, when we're talking about a check back here, this is going from 20% vol to maybe 15% vol. We talked about before, that's about 50 cents in that example before. That impacts your options price by 50 cents or so. But look at delta. Just a single dollar move will affect your option price by 50 cents. So don't go overboard with volatility. And as you can see here, the thing about volatility is that many times, just because vol is low, it can stay low for very long extended periods of time. So if you're using volatility to optimize your strategies, you can have long periods of time where volatility remains high and doesn't really correct back to its mean. So don't just use that as your sole decision-making factor when you're trading options. And I hope that makes sense to everyone. So please type 4 into the chat window if that makes sense. So with that, what I'm going to do is I'm going to actually jump over to OptionsPlay real quick before I continue, because so far I've dumped a lot of information on you that some of you may find confusing. And at the end of the day, it's not the most intuitive thing to learn. So what I want to do is I want to show you how you can apply what I've just taught you without having to do any of that math before. So let's go back to Apple, because that's the example that I've been using this whole time. Currently trading at 323. Let's say I buy a call option on Apple because I think the stock is going to continue moving higher. So we talked about delta, theta, and vega that affect our option price. We also talked about gamma that changes delta, right? So those are the 4 Greeks that we talked about. So why do we learn this? Again, we learn this because we want to know if the stock goes up 10% by this date and this happens to volatility, how much is my option going to be worth in the future? Well, you can certainly do the math yourself, and I encourage for those of you that are interested in math to try to do it on your own. It is, I would say, rewarding to figure it out, but OptionsPlay calculates all of this stuff for you so that you don't have to do the math. It's just important that you understand them. So if you have an option that you paid here, in this particular case, $11.70, $1,170 for this particular call option, and you think Apple, which is currently trading at 324, is going to go up to 350, and you think it's going to happen in the next, I don't know, month or so, and volatility currently at 24%, you think is either going to move higher or move lower, you can utilize these tools to do the calculation for you. So what we've done is we've calculated delta. We've also calculated how much delta will change if the stock goes up by $27, and we factor that into your price in terms of delta. We've also factored into how much value does the option price lose as it approaches expiration. So notice how if the stock moved up to 350 tomorrow, you'd make 146% return. But if you held it all the way through expiration, you start to lose value. That's the time decay that we're talking about. And lastly, if you have assumptions on volatility, again, volatility only affects your option prior to expiration, because at expiration, the only thing that affects your option price is the difference between the strike price and the current price of that stock. So you can take a look at these tools to give you a sense for what is the actual impact that volatility, time, and the underlying stock price will actually have on your option. As you can see, again, the delta slider is the one that impacts your price the most. Theta will certainly have an impact, but it won't be huge, or it won't be life-changing in my opinion. Same thing with Theta. Theta usually will move your option value, but it's not going to be life-changing. Delta will move, your strategy from, being down 50% to being up 50% within just a fairly small amount of change in the underlying stock price. So that's why I always, and again, reiterate that delta, in my opinion, is the most important aspect to understand. And you can do this for any option, right? And it's not just a single option. If you have multi-leg options, that's where it's impossible to do it in your head, right? If you were really smart, you can kind of figure it out, based on delta, theta, vega, roughly how much money you would make using back of the envelope calculations. But once you get into 2 legs, 3 legs, 4 legs, it's really impossible to do that. And that's why we created the P&L simulator, so that you can still get the same benefits of calculating what your expected outcome of the underlying stock should be in the future without having to do a single math equation at all. You can just use these price sliders to do that work for you. So I hope that you guys have, I hope that for those of you that have been on my webinars before, this is nothing new, but for those of you that are new to trading options and you're trying to think about, hey, if I'm buying an option, how much am I going to make? That's what the P&L simulator is designed to help you do, okay? So the next thing that I really want to talk about is time decay, because again, time decay is, in my opinion, one of the most misunderstood aspects of options trading. I think delta is fairly simple to understand, but when you get to time decay, it gets a little wonky. So I want to walk people through time decay, because in the example before, I showed you that in the, let's just go back here real quick. I said that for every day that it goes by, the option will lose 5 cents per day, right? Theta tells us how much money the option will lose as you approach expiration. Now, this actually does not do Theta a lot of justice, in my opinion, because Theta, like delta, also changes as time goes on. So delta will change as the price of the stock moves higher and lower. Theta will also change as you approach expiration. Now, the question is, how does it change? And the answer is theta accelerates. It actually gets faster as you get closer to expiration. So here I have a chart of the value of an option and how it decays over time. And as you can see, as you get closer to expiration, the speed at which this value of the option decays gets faster and faster. So here, and this is not to scale, and this is not meant to be an accurate representation. This is meant to give you just a sense for the acceleration, if you will. But if you buy a 12-month option, during the first 3 months of that option, from 12 months to 9 months, you're going to experience relatively small amounts of decay. This is not to scale, but during the first 3 months, from 12 months to 9 months, you're going to experience almost very little time decay. As you get closer from 9 months to 6 months, you're going to experience a little bit more. As you go from 6 months to 3 months, you're going to experience even more. And as you get into the last few months, that's really when time decay really accelerates. So why is this important? This is really important in helping us better understand how to select the right option expiration and strike price. So because when we're buying options, guess what? We want to be on the longer end of this curve, because when we're buying an option, what do we want? We want the value of that option to rise, right? So we certainly don't want the value of our option decaying to zero very rapidly when we're buying an option. And if we're selling an option, what do we want? We want the value of that option to go to zero, right? So when we're selling an option, we want to be at the shorter end of the curve. So when we're buying, we prefer to be up here, right? And when we're selling, we want to be down here. So that's how we that's how we think about selecting expiration dates and strike prices. It really depends on whether you're buying or selling. When you're buying, you want to go longer dated. When you're selling, you want to go shorter dated. I hope that makes sense to everyone. Please type 5 into the chat window if that makes sense. Okay, perfect. I see a lot of 5s. So let's take this one step further, right? We talked about expiration dates. Now let's overlay strike prices on top of this. So buying and selling, you have a lot of choices, right? You can buy or sell, and you can trade in the money, at the money, or out of the money calls. So guess what? In the money calls, out of the money calls will decay at a different rate. So for those of you that have ever looked at an option chain, you'll see that in the money options have very little extrinsic value. So what that means is that there's less value to decay. But when you trade an out of the money option, it's all extrinsic value. So it's all going to decay away. So what you see here is that in the money options will decay at a lower rate, versus out of the money will decay at a higher rate. So for the same value, so for the same expiration, so let's say you're looking at a 3-month option, the speed at which that 3-month option in the money will decay will be slower than the decay of a 3-month out of the money option. So the slope of those two lines are different because that out of the money option will decay slower. So let's think about this, right? When we're buying an option, what do we want? When we're buying an option, we want the value of an option to go higher, right? When we're selling, what do we want? We want the value of the option to go lower. So how can we use this curve to give us an understanding as to where we should buy and where should we sell? And the answer is, if we're buying, we want that decay to be as low as possible, right? So where on this 3 curves do you see the lowest decay? Where does it decay the slowest? Is it in the money, at the money, or out of the money? And is it short-term or long-term? Okay, so a lot of you have said in the money, great. So, and then would you go long-term or short-term if you're buying? In the money, long-term, exactly. Gregory's got it right. So the question is, how you don't have to go out 1 year, but somewhere at least in this particular range is probably a good starting point, right? Now, the reason that we point this out, that in the money long-term is the best place to buy, the reason that we use this curve to figure that out is because when you look at an option chain, an in the money long-term option is probably the last place you're going to look, because it's going to be really expensive. Those options are most expensive. And when we're buying, what do we want to do? We want to buy low, sell high, right? We don't want to buy something that's already high, but that's very counterintuitive. And that's why it's so important that when you're trading an option, that you think about utilizing this type of curve to help you determine where you want to buy, right? Now, I have 0, 3, 6, and 9. Again, this is not to scale, so don't use this and say, oh, you should buy a 6-month option. What I'm basically saying is that when you're buying, you want to be somewhere around here, because the decay is very low, so that it doesn't work against the fact that you want the value of your option to increase in value. Now, let's say we're selling options, right? We're selling a cover call, we're selling a cash secured put. Where do you want to be then? Do you want to be in the money, out of the money, or in the money for selling options? And do you want to be short term or do you want to be long term? So everyone's answering short term, and Ro and Joseph and Gregory, very good. You want to sell out of the money short term. You want to be over here, right? You want to be on that outer blue line. You want to be on that outer blue line, when you're selling an option, because when you're selling an option, you want the value of that option to decay as fast as possible. You want it to go from $1 to 0 as quickly as possible. And you're going to be able to do that when you go out of the money short term. Okay. And that's why whenever we're doing these webinars, whether we're doing covered calls, cash secured puts, I always teach you sell short term out of the money options. When you're buying, you go longer term and you go in the money. That's the reason for it. And the reason that I brought up this chart is because if you just look at an option chain, out of the money short-term options is usually the last place that you're going to look, because those options are really cheap, right? You want to sell something with a lot of premium, but when you sell something with a lot of premium, guess what? It doesn't decay very fast, and it's not what you want. So hopefully this chart helps illustrate to you why, when I'm teaching you in some of the other webinars, to select certain expiration dates and strike prices for buying and selling, it's really because of these particular reasons. So, well, actually, before I move on, I just want to make sure everyone understands this, right? Because this is, it all comes down to this. Everything that I've talked about before, delta, theta, vega, volatility, time decay, it all comes down to really understanding this chart and understanding why, when you're selecting these options and you're buying, that you want to choose certain types of options, and you're selling, you want to choose other types of options. So if this makes sense to you, please type 6 into the chat window. Okay, perfect, great. So let's take a look at a case study. And I want to use this case study because, again, even though I just told you all of these things, I want you to see what the difference between buying in the money, at the money, and out of the money options really look like. Because at the end of the day, I get a lot of questions saying, hey, I'm bullish on a stock. Should I buy an at the money call, out of the money call, in the money call? And the answer is, it really depends on what you're looking for. And the only way to really decide for yourself is to really understand the difference between each one. So the next exercise, what I want to do is I want to break down these 3 trades, show you how they perform in various scenarios that are likely going to happen if you are bullish on a particular stock, so that you can see for yourself what the outcomes are, and then hopefully make a better decision next time you are buying an option as to which one you want to trade. So an investor is interested in stock XYZ at $100. In this particular case, this investor is bullish. So this person is going to look at buying 2-month call options. Current implied volatility is 20%. Let's assume that this stock pays a 0% dividend yield. So this stock is just a straight bullish stock that you're bullish on, and you're buying some call options on it. You think it's going to move higher. So let's take a look at buying various call options and see how this performs. And what I'll do is I will compare buying a in the money call, so a $100 stock, buying a $95 call, which is in the money, a $100 call option, which is at the money, and a $105 call option, which is out of the money. So first of all, just to give you a better sense for how this performs, actually, what I should actually do, which I don't have here, I apologize, is tell you what the starting deltas are. So the starting deltas here should be roughly 0.5 for the $100 call, because an at the money call is always 0.5. An in the money call is always higher. So let's say it's maybe about a 75 delta. And then let's say this one was 25 delta. So again, I apologize, but these are the starting deltas. So when I bought these call options and the stock is at 100, these were the starting deltas. In the money had the higher deltas, out of the money have the lower deltas, at the monies have the 50 delta. And here what I've looked at is, let's say in this particular case, the stock rises $5 to $105 in 30 days. So halfway through expiration, I bought a 2-month option. Halfway to expiration, the stock rises by $5 to $105. And I want to show you how each strategy performs. So what happens is when the stock rises $5, guess what? The delta also increases. It increases to 90 delta. The 50 delta increases to 75 delta, and the 25 delta increases to 50 delta. So I bought these options originally for $7, $3, and $1. So the in the money options are most expensive. The out of the monies are the cheapest, and the at the monies are somewhere in between. So here are the exit prices, or the value of the option as the stock rises $5. So here it went from $7 to $11 because the stock moved up $5. Here it moved from $3 to $6. Here it moved from $1 to $3. So smaller dollar gains, so $4 gain, $3 gain, $2 gain. But as you can see here, because this cost me significantly more capital to get into it, I only make about a 57% return, which in my opinion, not a bad gain considering the stock only rose 5% in 30 days. You make 57% gain. But again, I'm not here to judge. I'm just here to show you what the different outcomes are. If you bought the at the money option, you'd be looking at a $3 gain, which because it only costs you $3 to get it is 100% gain. And lastly, the out of the money option, only a $2 gain, but because it only costs you $1 to get in, you're going to get a 200% gain. So at this point, a lot of people will say, well, I'm just always going to buy out of the money options. And this is really where, when you're looking at that option chain, people tend to gravitate towards that last option because they think of options as kind of a bit of a lottery ticket or gambling, and they say, well, why shouldn't I buy something for $1? The most I'll lose is $1, and best case scenario, I make a 200% gain instead of a 57% gain. And that is really where I think is the most counterintuitive part of trading options, because as I showed you before, where should you really be buying? You should be buying in the money when you're buying. You should be longer dated in the money as opposed to out of the money options that will decay very, very fast. And I think that will be illustrated in the next slide here, because let's say the stock rises $5 to 105 in 30 days, but let's say after 60 days at expiration, it's still at that 105. Now let's take a look at what happens. So here, as you can see, now the delta from before will actually decrease a little from when it was at 105 30 days away. So now the value of my option went from $7 to $10, $3 to $5, or $1 to $0. So this is really where you can get a sense for how time affects the value of your option. In the previous example, we showed you how delta affects the price of an option. Now let's take a look at how time. So now that the stock moved up $5, but another 30 days went by. So guess what? I'm going to lose some value on my option. So in my in the money example, I'm looking at a $3 gain or a 43% gain. On my out of the money, I'm looking at a $2 gain or a 67% gain. And my out of the money options are worthless because at 105, a 105 strike call is worth nothing. Even though I only paid $1 for it and I lost $1, I lose 100% of my investment. So even though that the stock went in the direction that I expected it to, because it didn't move large enough of a move, I lose 100% of the money that I lose. So that's the downside of trading out of the money options, is that it's very easy for the stock to move in your favor and still lose 100% of your investment on that option. And that is, again, why we generally don't recommend that if you're buying an option to go far out of the money or go out of the money at all, because you have a very high probability of just losing all of your investments. Either one of these other two strategies are, in my opinion, a better place to be, because you're going to have a higher probability of making at least some profit and you won't hit it out of the park all the time, but you have a much higher probability of at least having some profit, especially when the stock goes in your favor. So does that make sense to everyone? Please type 7 if that makes sense. Perfect. Okay, last couple of slides. So now let's look at what happens if I bought these call options and the stock doesn't move, right? So it doesn't move higher, it doesn't move lower. 60 days later, the stock's still at 100. This is really where things start to look quite different. So delta here will decrease. Here, this will go all the way to 0. So now, if the stock stays exactly the same, one of the things about buying an in the money option, whoops, let's change the color here. One of the things about buying an in the money option is that when I showed you before, the in the money options decays very little. And this is true because most of it is intrinsic value. There's very little extrinsic value to decay. So in this particular case, even though the stock didn't go anywhere, here I only lose $2, which is a 29% loss on my investment. Versus the at the money, I lost everything because a $100 call option when the stock is at 100 is worthless at expiration. So I lose 100%. Same thing with the out of the money. I also lose 100%. So as you can see here, there's a benefit to buying in the money options when the stock doesn't move in your favor, because even if it doesn't move at all, you're not going to lose 100% of your investment as you do when you buy an at the money or out of the money option. So keep that in mind next time you're buying options, thinking about which one you want to select. And lastly, what happens if the stock declines $5 in 30 days? So now the deltas will decrease, right? So originally it was 0.75, it's decreased to 0.5. The 0.5s will decrease to 2.5, and the 2.5s will decrease to 10 delta. So here, that's when you're going to see well, here there's actually a $5 loss, I apologize, versus a $2 loss versus a 75-cent loss. But as you can see here, when the trade goes against you, still, there's going to be less of a loss on the the in the money options from a percentage perspective versus the at the money and the out of the money options. So again, this exercise was really just to give you a sense for when you buy in the money, at the money, and out of the money, how they actually perform in different use cases. Because a lot of you ask me this question, a lot of you, when you're staring at that options chain, you're asking yourself, which one should you choose? It's not easy to pinpoint one or the other, but hopefully this exercise gives you a better understanding to see how each one of these perform in different markets, whether the stock moves higher, whether it moves lower, or just stays exactly where it is. But again, it all circles back to that one slide that I showed you here before with that, with this curve. So if there's anything that you walk away with today, I want you to try to remember that when you're buying, you generally want to be out here because again, when you're buying, you want the value of your option to increase. So you don't want time decay to eat away into your profits. And when you're selling, you generally want to be shorter term and out of the money because when you're selling, you want the value of your option to decay very quickly. And use this concept that options will decay at different rates, out of the money and in the money will decay at different rates to your advantage when you're buying and selling, even though when you look at an option chain, long-term in the money calls is very counterintuitive to buy because they're very expensive. On the same token, out of the money short-term options are really cheap, counterintuitive to sell, right? Because when you're selling, you want to sell high. When you're buying, you want to buy low. But this is the counterintuitive part of options that if you learn will help improve your options trading. So with that covers what I wanted to share with you guys here today. I hope that you guys have found this useful in better understanding your concepts for trading options. And at this point, what I'll do is I will open this up for Q&A and allow you guys to ask any questions you have regarding trading options or Greeks. And I will scroll up and try to see what questions you guys had before. So today is a little different format than usual, but I hope that I was able to cover some important concepts that some of you may be a little scared to approach sometimes. Bob, thank you so much. Robert, Robert, I haven't seen your email. If you don't mind, send me an email at info@optionsplay.com. I haven't seen any emails from you, Robert. So here, I'll send you the email info@optionsplay.com. Oh, Robert, thank you. I will write down your email address and I will try to give you a shout after here today. So let's see. Let's take a look at the questions here. So KC is saying, can you please show how change in IV in options play, especially to simulate IV and stock price for earnings trades? So KC, we actually cover this pretty heavily in our earnings webinars. So if you want to watch one of those recordings, please do. But basically, you can utilize options play to say, let's take a stock that's reporting earnings next week, like Disney. Let's take a look at Disney here. Disney reports here on February 4th. Let's say you're bullish on Disney and you think the stock's going to move higher. You can use this price slider to say a few days after earnings, let's say on February 6th, volatility comes down and you think the stock is going to jump to, let's say, 143. How much money do you make on that call option that you purchase? You can utilize this tool this way, KC, to look at how IV affects your options trading, especially around earnings. Richard saying, does your app pick trades? Richard, I would say our app guides you to your trades. So I wouldn't say it picks trades for you. There's, we're not here to tell you what to trade. We provide ideas, we provide guidance, we provide a lot of things to help you analyze and do it. And all of the webinars that we do are really designed to help make sure that you understand how that happens. Let's see. Wayne, thank you so much. I really appreciate it. Adrian's asking, if theta is 0.5, does that mean the option loses 50 cents throughout the day? So if it's 0.5, then yes, it means it loses 50 cents per day. And that loss will happen throughout the day. Now, keep in mind that theta, when we talk about theta, this is in a vacuum, meaning if everything else stays constant, if the stock price stays constant. But, at the end of the day, a stock price isn't typically constant, right? So when we talk about theta, this is saying that if everything else is constant, then yes, you would lose 50 cents on that day. But if delta also moves up, if the stock also moves up $1, you have to also factor in how delta and gamma, increases the value of that option against the theta that you lose. Bob is asking, is a day for time decay trading day or calendar day? Great question. The answer is calendar day. Stuart saying, in the week, won't delta change as well? Stuart, if you really want to get nitty gritty, the answer is yes, but the changes in delta purely due to time is actually very, very small. So the answer to your question is yes, but I would say negligible for our purposes. Peruse is asking, can gamma be a negative number? So whenever you're long an option, you're long gamma. When you're short an option, you're short gamma. So yes, but only if you're short that option. Jim is saying, when are we concerned with gamma? That's a really good question, Jim. So for those of you that do have some experience trading, you might notice that gamma is highest at expiration. So but it's only highest near the money options at expiration, meaning, and the reason for it is because, think about it, if an option is very close to expiration and it's at the money, just a couple of pennies can move that option from being in the money to out of the money from at expiration. So gamma is highest only at near the money options at expiration. Let's see, a lot of questions here. Thank you so much for all the questions. Does gamma react soon after earnings? So again, gamma doesn't really react too much to many other things other than time. So gamma is really affected by being options that are near the money. So if you have options that are out of the money, even at near expiration, they really doesn't come into play. They only come into play on options that are near the money. Manny's saying, can you send us a recording? So all of our webinars are recorded along with the slides so that you can re-listen and understand the Greeks at your own pace. Wayne is asking, but should we stay away from trades at earnings because of the higher volatility drop? So Wayne, that really depends on who you ask, right? So yes, volatility drop will work against you if you're buying an option, but if you're selling an option, it works in your favor. So that volatility crush is only working against you if you're long that option. So those are some of the things that we discuss on our earnings plays. And if you want, I don't know if any of you, if you followed, my my Intel trade from a couple of weeks ago on CNBC, I used an option selling strategy because vol was really high going into that Intel earnings. And that was one way to extract some yield by selling volatility going into earnings. So there are ways that you can harness that elevated volatility going into earnings by selling, but it's not for every single situation. Wayne is saying, how important is the volatility rank of an option to determine whether a price is expensive or not? So I would say volatility rank is the only thing that you should look at to determine whether an option price is expensive or not. But again, I want to reiterate, looking at volatility, it is not always crystal clear, right? Because, this is one of the things that, I think probably had a lot of people out. So this spike here, this big spike here was during that December sell-off, right? So, if you looked at the implied volatility rank on this day here, it probably would have been 80, 90%. Guess what? Just because it was 80, 90% does not mean that volatility can't move higher. So, Yes, you can use volatility rank to give you a sense for whether vol is high or low, but just because it's high doesn't mean that it can't move higher. Think about Tesla. You know, when it hit, I remember, you know, I was on January 2nd when Tesla hit 420. Everyone was saying that this was the highest it'll be. Volatility was at its all-time high, despite making all-time highs. And guess what? As the stock kept moving higher and higher and higher, volatility just kept moving higher and higher with it, which is very unusual. But again, volatility rank is not a you know um, it's only one tool in your toolbox, and keep in mind that even if you get volatility correct, you can still get direction completely wrong and get killed on delta, even though volatility is working in your favor. So yes, you might make a couple of bucks from Vega, but then lose $15 to delta. And what's the point of that? And that's why I always tell users, don't just look at IV rank to trade your strategies, because IV is only a part of your strategy. I hope that makes sense to those of you that trade using volatility. So Ro, I think Ro was referring to, you know, your comments to the changes, you know, on this. I just hope you know that these were illustrative. These were not exact by any means. This was just to give you a sense for magnitude. They are, again, not exact at all, but it does give you a pretty good sense for the magnitude. Wayne is asking, is it in the money and at the money price gains at expiration based on them having intrinsic value compared to out of the money that has no extrinsic value? Wayne, I think I've lost the context of that question, but I believe your answer is correct. Adrian, I think I've answered your question already. Jim, thank you so much. I appreciate it. Daryl, yes, the slides will be available. Dennis, same thing. Yep, this will be, Dennis, Alex, these will be recorded. Haltor, you're very welcome. Gregory is asking to exit a profitable trade. Is it better to roll it or exit and start another trade? So Gregory, that purely depends on whether or not you think that the stock is going to continue moving in the direction that you expect it to. If you think it's still going to continue moving in that direction that you expect it to, you might want to roll it to a further expiration, lock in some gains, and remove some risk off the table. If you simply think that the move is done, like the Intel and GE trade that we've traded over the last couple of weeks with options action, as soon as that move happened, I took profits because I simply did not think it was going to continue moving. So it really just depends on your directional view of that stock going forward after you close out the initial trade. Michelle, you're very welcome. John, thank you so much. I appreciate it. Joseph, thank you so much. Jim, at the money bull call verticals mitigate how much theta decay typically? Great question, Jim. So the bull call verticals are really designed to try to take advantage as much as possible of that theta decay, because what you're doing is you're buying this down here, right? You're buying this down here while selling this up here. So I will say that generally speaking, you should be able to offset at least half of the time decay in a bull call vertical, but it heavily depends on the volatility of the options. So it's hard to say that there's a general rule of thumb there, unfortunately. Alan, thank you so much. I appreciate it. Robert saying, how much does the volume affect options price? Volume does not affect options price at all. So that's why, again, open interest and volume, not very important in trading options unless the stock just has zero open interest, which is obviously not great or not desirable. But volume in itself does not really have anything to do with options, or I'm sorry, the price of an option. Wayne is saying, even though there are not option Greeks, how much consideration do you put into looking at put call ratio and open interest? So again, I really don't look at those things at all, Wayne. You know, bid ask spreads are much better gauge for liquidity, which is typically what you're looking at. Put call ratio is not, it's not something that I typically look at, but I will say I look at the VIX quite a bit. And if you look at put call ratios and VIX, they are fairly correlated. So I will say that those types of indicators are useful, but I tend to find that they're more useful in calling market bottoms than they are at calling market tops. So when volatility is like here, when you get these spikes in volatility like you get here, these typically correlate with market bottoms. If you look at a chart of the S&P correlated with these strong peaks, you know, especially when those peaks happen near the top of IV rank or IV percentile, those usually correlate pretty well with the market bottoms. So that is one thing that I do look at. How do we find percentage probability in addition to OptionsPlay score and profit numbers? So those are all available to you on OptionsPlay. So if you're looking at the probability of profit of this call option, just click on the OptionsPlay score and we'll show you the probability of profit. Casey, thank you so much. Surrender, Stuart, thank you so much. Thomas is saying, in general, do you lean towards buying debit spreads rather than selling credit spreads, and why? So the answer for me, as far as leaning towards trading debit spreads, is really the risk to reward ratio. You know, I think that I have a pretty, so I have a pretty good sense for where I think the stock's going to go, but I don't have a crystal ball, right? So if I'm right 60% of the time, I would say that I'm pretty nail on, you know, when I'm right 60% of the time. I'd rather risk $443 to try to make $857 when I'm right 60% of the time. If you're selling a credit spread, yes, you can have a higher probability of profit, but, you know, even if I'm right 60% of the time, the problem is that I'm risking $450 to just make $241. So I don't love the odds of credit spreads as much. You really have to be right a lot more often. And guess what? You know, especially in this market, trends don't stay very long. Things move very quickly. And, you know, credit spreads are just harder to trade, in my opinion. There are times when volatility is really high where it might make sense to sell a credit spread, but, you know, volatility really high doesn't come around very much. For those of you that watched the webinar that I did with Tom Sosnoff last month, for those of you that listen very carefully, he said that stocks are only above 50% IV rank 25% of the time, which means 75% of the time, volatility is on the lower end of the spectrum. So that's why you lean more towards trading debit spreads versus credit spreads. Larry's saying, can you explain a bull calendar spread? A bull calendar spread is really just buying a longer term option and selling that short term option. It's really taking advantage of this curve that I was telling you about, right? So the best of both worlds, a bull calendar spread is buying something out here and selling something over here, so that you really are utilizing this curve to the best of your advantage. That's what vertical and that's what calendar and diagonal spreads do. Alex saying, do I need a password? Alex, I'm not sure what you mean by that. A password to what? Robert saying, how do you get to the score? Disney shows 76, but a 31.26% return in 40 days. Is that not a good return? So I would argue that that's not so the score is really telling you how expensive that option is. And it's expensive because Disney reports earnings next week. So it's really more of a factor of how expensive it is. You can still make money even though an option is expensive. You just can't make as much. When I join you, do you suggest when to get in and out on a timely basis? So Alex, on the trades that we send out, we will always tell you when to get out, such as the trades that we sent out today. We suggested closing out GE and Intel. So yes, we do send out alerts. Wayne is saying, looks like we have two Waynes. So I do see both of your last names. So I've got both of you, Wayne Killingbeck and Wayne King. So Wayne King is asking, is vol rank for an individual option sometimes shown anywhere on OptionsPlay? So Wayne, that is something we are working on, of adding that to our tool, and we hope to have that in the next month or two. Andy's asking, bullish stock should have bullish sector. So Andy, that is a general rule of thumb that we generally have with trading options, is that we try to select bullish stocks in bullish sectors or bearish stocks in bearish sectors. We don't always find those types of opportunities every single day, but as a general rule of thumb, that's what we try to find. John, Gregory, Bob, you're very welcome. Tom, thank you so much. You're very welcome. Guy, Jim, JT, Lauren, Oznat, Victoria, thank you so much. I really appreciate it. Irving, how important is gamma to a successful butterfly? Irving, I would say gamma is extremely important to a successful butterfly because butterflies are most sensitive to gamma because you have two options that are near the money, hopefully near, many times you're trading butterflies closer to expiration. So, the value of a butterfly can change very, very quickly due to the effects of gamma. So very important in my opinion, unless you're closing out that butterfly well ahead of expiration. So if you're trading a butterfly, you're opening at 45 days out and you're closing at 21 days before expiration, then I would say gamma is less of a concern. And many traders do that. Many option sellers will buy back their option 21 days from expiration because they don't want to deal with the gamma risk. The Black-Scholes model determines options price, but you don't mention it. Well, Richard, that's how that calculator determines the expected future value of an option, is using the Black-Scholes model. Todd, you're very welcome. Randall, you're very welcome. Wayne, Thomas, Alex, thank you so much. Alex is asking, low volume does not increase spread between bid and ask. It does. So there is a high correlation between stocks that have low volume and higher bid-ask spreads. But again, there are plenty of stocks that have lower interest, lower open interest and volume that have tight spreads that just not a lot of people trade options on. Wayne is saying, does the OptionsPlay score for an individual option incorporate the volatility rank? It does in an indirect way. So the higher the IV rank, the lower the score, meaning the more expensive it is to buy that option. The cheaper the option, or the lower the implied volatility or rank, the higher the score, because the cheaper the options are. Perose is asking, can you explain vertical trade? So Perose, I'm happy to do that. However, I do have a whole webinar just on that alone. So I encourage you to take a look at the recordings on that. You can access them using our YouTube channel. I highly recommend you to do that. I just sent you a link into the chat window on how to access it. We cover debit and credit spreads. We also cover the difference between debit and credit spreads. So I highly recommend you to take a look at that. Andy is saying, in the Intel sell to open 56.5, 59.5 put vertical, which leg is buy, which leg to sell? We sold the 59.5 and we bought the 56.5, Andy. Ed is saying, just to be clear, just to be sure that I am clear, are you saying that you are not a big fan of selling credit spreads right now in the low volatility environment? So when we say low volatility environment, that means the market has low volatility, but there are plenty of stocks with lots of volatility. So I wouldn't necessarily say that's true, because you have to look at the volatility of the individual name that you're selling vol on, right? So selling vol on Disney right now, very high vol. I don't think selling a vol on Disney is necessarily a bad trade because of how high it is. Selling vol on Tesla, selling vol on even Apple going into earnings. There's still plenty of names with very high vol. So yes, we're in a low volatility environment, but that's more so for the overall market. So I wouldn't necessarily, use that as the only gauge to sell vol. Wow, there are so many questions here. Hopefully I can get to all of you. How do we find percentage of probability in addition to the score? I think I answered that already. Does OptionsPlay work with iron condors and butterflies? Yeah, absolutely. You can click on modify, click on neutral if you want to use butterflies, condors, all types of strategies. You can click it by the click of a mouse, change the width, change the wingspans, just move the strikes left one, right one, just by all the click of a mouse. This is all designed for those of you that want to trade more advanced strategies instantly, to be able to set up these types of strategies. Daryl, you can send me an email at info@optionsplay.com and I'll try to look into that for you. John is saying, when selling options for premium is a lower delta, a good guide is to use to determine the stock price will be called away. John, I'm not 100% sure of your question, but I think what you're saying is that when you're selling options, you want to use a lower delta. If that's what you're saying, then yes, that is exactly what you should be doing. Alex saying, when you say if stock does not for a few days get out of the trade, what is a few days? Oh, literally 3 to 5 days, if that's what you're asking, Alex. Jake, thank you so much. Manny, Terry, you're very welcome. Alex, you're welcome as well. Adrian, if you sell a call and put just out of the money days before options expire when theta is really high, would you not make because of decay? Adrian, yes, absolutely. Just the thing is that when you sell an out of the money call or a put, it does require a fair amount of margin to sell a naked call and a put. So yes, you will have a very high rate of decay, but your returns may not be very good. So let's say you sell something for $1, but you have to post, I don't know, $2,000 in cash to do so. Then you're making $1 out of a $2,000 risk, or at least $2,000 cash that you need to place that trade. And yes, you might be able to do it over just a couple of days, and you might annualize that out. But it just depends on whether or not that's the type of risk profile that you're looking for, Adrian. But you're absolutely right. Sue, you're very welcome. Adrian, say you did it at the start of the day and close at the end of the day of expiration. Yeah, Adrian, there are people that do that. But again, if you start at the day of expiration, you might only collect 5 cents, 10 cents, but have to post a few $100s in margin. So it's just up to you as to whether or not that's the right trade for you. Wayne is saying, as a general rule, does OptionsPlay score below 100 imply that the option price is generally higher than if you were north of 100? Yes, absolutely. That's exactly what that means, Wayne. Alex, yes. So a few days before below 64 is referring to usually 3 to 5 days. Chris, you're very welcome. I'm really glad that you are able to learn. Alex, how many trades do you suggest a week? I think we average about 3 a week. I don't have Iron Condor availability on my OP. I sent you an email yesterday. Wayne, do you access OptionsPlay through another platform? Perose, it's not tms.optionsplay.com, it's tmx.optionsplay.com. So yes, that website is still available. So it's tmx.optionsplay.com. That's for those of you that are in Canada. Robert's asking, which options Greek is most important to look at? As I said before, delta is by far the most important one. Daryl saying, did you exit the debit spread at GE because it was nearly reaching 13? Yes, that's exactly why I exited. It reached the target price that I had. John, you're very welcome. Okay, that is the end of the questions. Thank you so much for taking the time out here this afternoon. I really hope that you guys have found this useful. It is not an easy topic to learn. It is certainly not a fun topic to learn, in my opinion, for many people, but hopefully that this was helpful for you guys. Again, for those of you that stayed to the end, thank you so much. I hope that you guys consider supporting us if you are still on a free trial by signing up and becoming a member. You can do so using the link on your screen, and I just posted that into the chat window. So I hope you guys have a great afternoon, and I will see you guys next week, and we will send out the recording to everyone in a few minutes once we finish wrapping everything up. So have a great evening, and I'll see you guys next week.